Well, now turning to currencies, and Chile has become the latest nation to take radical action in the face of a softening US dollar. The peso shot to its weakest level in 3 months after the central bank embarked on the biggest ever dollar buying program. Right now, $1 is worth about 495 pesos. That's 6% more than 2 days ago. And that's the most dramatic change in 2 decades. Well, Chile is attempting to weaken its currency after gaining 17% against the dollar since June. And that is more than any other currency except for the Aussie dollar. Its central bank plans to buy $12 billion this year, kicking off with 50 million a day until the 9th of February. Well, is this move going to pay off, or will continuing stimulus from the Fed mean that Chile's program costs more than it's worth? Well, for a little bit more analysis on this now, I'm joined by Nigel Rendell, a senior emerging market strategist for RBC Capital Markets in London. Thank you for joining us. Can you talk us through the reasons behind Chile's move and what effect you think it's likely to have in the medium term?
Yes, well, it all really stems from the problems we've had over the last couple of years, and low interest rates in the States and elsewhere, and quantitative easing from the Fed. All has sort of contributed towards a weaker dollar, and a lot of the emerging market currencies have appreciated on the back of that. So we've seen big rallies in the Chilean Peso, as you've mentioned, but also, a lot of pressure on some of the Asian currencies to appreciate. And that makes their exports difficult to break in or to sustain their export markets in Europe and in the States. So they want to try and limit the appreciation, and Chile's going around it in this particular fashion.
Yeah, I suppose the question is it likely to work? Or, in fact, is it actually just going to be harmful to make such a quick adjustment to the economy?
Well, it's worked in the sense over the last few days we've seen a 6% depreciation of the currency. I think perhaps there may be a little further downside short term for the Chilean peso, given that positioning was quite strong in the opposite direction before they announced these moves. But over the longer term, I don't think it's going to have a dramatic impact, in Chile or perhaps in some of the other emerging market countries that have tried alternative methods of cutting interest rates and intervening and so forth. The real issue is that we have interest rates very low in the States and in Europe, and in a number of these other markets, interest rates are attractively high. So the money flows to where you can get the best rate of return. No,
you mentioned that other countries are trying different methods. Can you see more intervention? Is this a trend that we're going to see throughout 2011, where these emerging markets are trying to pull their currencies down?
I think inevitably, yes, that will be the case. We've seen it over the past year or so. The Asians have been very active, limiting the rate of appreciation of their currencies. But we've seen other central banks, from South Africa to Brazil. In Brazil this morning has increased reserve requirements to try and stop hot money coming into the country. Turkey has been cutting interest rates perhaps a little faster than most people would have thought was prudent to try and stop hot money. So it's a whole combination of factors driven by the fact that global rates in the States and elsewhere are so low.
Now, it's hard to talk about emerging market economies without bringing in China. The situation is slightly different in China. Inflation really is still top of the agenda there, isn't it?
Yes, it is. Inflation has been rising over recent months, and I think it's really a case of the central bank there having to normalise interest rates, and in the process of normalising rates, pushing them higher, they'll be forced to let the currency continue to appreciate against the US dollar. But it's the speed of appreciation which is the key for the market. It's going to be a gradual move to something probably around 6.20 or so by the end of the year on our numbers.
OK, Nigel Rendell from RBC Capital Markets, thank you very much indeed for joining us.